So the big topic, forward testing, back testing, and when and how to make adjustments. Very important, but most people do it in the wrong way. They get the wrong expectancies from their forward testing and their back testing. And usually a profitable back or forward test does not translate to profitable live trading, and then people get disillusioned. And we will take a look at all the problems now, but of course also the opportunities. So back and forward tests, they are inherently different. Why is that? Well, because when back testing, then you can fast forward the time. With most softwares out there, like Forex Tester, or even if you only use an EA on MetaTrader, for example, backtests can be fast forwarded. So the psychological effect of that is immense. I warn you not to underestimate that. Seriously. Because you can fast forward through so much time, through so many candles in such a short time, that it doesn't really matter to you whether you only have one setup per month on a given instrument. For example, waiting a real month for a setup, that can be a tough job. Waiting for it in a backtest is maybe only 1 minute, okay? And the same goes for executing trades. Whenever you open a trade, you can fast forward it to immediately see the results, okay? You get immediate feedback, and that feels good. And in forward testing or in live trading, you have to wait that out. And depending on which time frame you are trading, of course, that can be days or weeks. And that is a whole different kind of psychological pressure. And of course, if you then translate this experience to a forward test, you have to adapt. And then from the forward test, you have to adapt again to live trading, because demo trading feels completely different than having your own money on the line. And then, of course, in backtesting, you also are prone to curve fitting, because people don't use an out sample. You don't think clearly when you are trading live, and so on. So please don't be under the impression that if you have a profitable backtest, that it will translate into a profitable forward test or profitable live trading. Also, of course, because past results never indicate future results, never predict future results, but they, of course, can give a general direction of where you are heading with your system. Alright, so backtesting possibilities. You can use the MetaTrader 4 manually and or with the EA. So you can scroll through the charts manually and simply note down the trades you would have taken, or you can use a robot which basically replays old candles. Simply Google MT4 backtesting software or trade simulator. Sierra Charts, for example, has a replay function as well. You can also get Forex Tester 3. This is actually very useful because you can simulate a whole trading environment. You can have an account, you can calculate your risk and so on. So this is the complete backtesting experience for Forex Tester 3. I really like it. I think I spent days or weeks in that software when I first started out trading, more than I would like to admit. Okay, backtesting must-dos. I would advise you to go back a maximum of 3 years, because, as I said, markets are changing, past results are never a guarantee for future results, and going back too far simply disconnects you from the market. I think for day trading strategies, even 1 year is enough, absolutely. For strategies on the daily charts, 2 years is enough. Weekly charts, okay, 3 years if you want to. But as long as you can get a sample of, say, 50 to 100 trades out of a given year, so 1 trade per week, basically, then stick to the last 1 or 2 years. So you always have to use an out sample in order to avoid curve fitting. For example, if you're using 3 years of data, then take 2014 and 2015 for creating and optimizing your strategies, and then you test that strategy on the 3rd year. and you don't optimize anything on that third year. You just trade your strategy. And by doing so, you will avoid curve fitting, which is the death of every strategy developer. Yeah, as I said, maybe if you can, don't do it for too long, as you will get too used to fast forwarding, which can have detrimental effects on your ability to hold on to trades or to wait for trades later in the game. And of course, as with a live trade or a demo trade, you should use Edgewonk or any other means to analyze your performance, because randomly making adjustments to your strategy doesn't get you anywhere, neither in backtesting, nor in forward testing, nor in live trading. And most importantly, don't cheat. For example, don't test the same currency pair in the same year all the time, because you will subconsciously remember the data in that year and you will take great trades suddenly. And then you do a forward test on data you don't know yet, and suddenly your strategy doesn't work anymore. So yeah, don't try to not cheat, be it consciously or subconsciously. Forward testing must-dos. I would fund a demo account with the exact same amount you want to go live with. So you get used to the numbers alone, get used to the zeros, get used to how it feels to lose a certain amount, even if it's only virtual. And if after any rolling 90 trading days and or 100 trades, whichever happens first, you are profitable, then go live. Don't stay too long on demo, because again, trading on demo feels completely different than trading live. Having real money on the line will mess with your brain a lot. And then start trading with half of your intended capital, okay? And only top it up when proven profitable. Our goals as a trader in the first few years is to stay alive, not to lose our capital, so that when we are finally able to trade profitably, we still have money left. And if you lose 20% of that half of your intended capital, you go back to demo trading 90 trading days or 100 trades, and then you top up and restart the process. Yeah, as I said, try to get out of demo ASAP in order not to develop bad habits, and use Edgewonk or any other means to analyze your performance. Adjustments. Every 50 trades, make adjustments based on statistics, nothing else. I know I've said this many times before, but too many people, they change their strategy, they trade outside of their statistical parameters, they don't know what the hell they are doing. So whenever you trade a strategy, you stick to that strategy. And if you change it, then you only do it based on statistics. For example, Edgewonk. You adjust step by step. You don't adjust the whole strategy, because a trading system is like an ecosystem. Changing one factor will affect everything else in that system. And then you can't really tell what the hell is going on if you change your take profit strategy and your entry strategy at the same time. Or you add another factor for entering a trade and you change your stop loss strategy at the same time, and so on, okay? So you don't really know which factor now contributed to increasing or decreasing your performance. And again, don't be greedy. Never change a running system unless you find something much better. So in Edgewonk you can test alternative strategies, you can test your trade management and so on. But if you are already profitable, then your job is to stay profitable. And as long as nothing changes in the market conditions or in the way the market behaves, then just don't change your running system. Alright? You already have something that is making money. What else do you want? If you need more capital, then become better at acquiring capital, not at making more returns. That's it for this video. As always, any questions please on the forum.